Good afternoon and welcome to another in the series of Vanguard Wednesday Wealth Forums, where we discuss the cover article in the Wealth Lift out in the Australian this morning. Today we're talking internet stocks, and I have with me Rob Hopkins, co-founder of small cap investment manager Smallco Investment Manager. I've also got Carlos Gill from specialist micro-cap investor Micro Equities, and Tim Morris, who's senior analyst at independent research and advisory house Wise Owl. Good afternoon, gentlemen.
Good afternoon.
Good afternoon, James.
Now, we're talking, of course, about internet stocks, and if we had been talking about them 10 years ago in those heady days of 99, 2000, they would have been floating on massive premiums and rocketing off to the sky in share price terms without any earnings to speak of, and in some cases without any revenue. Now, that hype of 10 years ago that the internet was going to be the way to do business in the new economy took a while to become accepted, but Rob Hopkins, that seems to be borne out by the experiences of some companies.
Well, I think that's right. And the major internet companies in Australia, particularly the ones that are concentrating on what traditionally used to be the classified advertisements, so that's cars, houses and jobs, are doing very well. And it's an area where once one company gets a head start, they start doing very well, and they've been doing very well from a revenue and profit sense.
Rob, 10 years ago it was widely viewed that virtually all industries, apart from the very, very basic ones, like, for example, mining, it was talked about that there was most other kinds of industries could be quite a degree of what they did could be done by the internet. But as you say, that attack on the advertising space, which was held by the newspapers, that has proven to be the most apparent and most lucrative form of internet seizing of business.
Yeah, that's right. I guess a point worth making, though, is that we still have approximately 40% of advertising spend which is still going through print. That's newspapers and magazines. And so the print advertising is still considerably bigger than internet advertising, although, of course, print is slowly losing its market share and the internet is rapidly gaining market share.
And that very interesting statistic that, of course, Fairfax used to control those advertising revenue streams for jobs, for cars, and for real estate. And those, the three businesses, Seek, the online website, carsales.com, and realestate.com.au, three classic internet businesses, effectively took the great lion's share of that business away from the incumbent that had held it.
That's correct. That's correct. And I mean, there is those statistics where, for instance, in jobs, 80% of people would prefer to look online. 70% of eyeball time is spent looking online. But in fact, the revenue share is still something in the reverse, with 60% of the revenue still with the newspaper industry and only 40% online. And you would think that over time that will shift so that it goes into the internet space. And I think the reason that it hasn't so far is just inertia, and companies just have a traditional way of doing business and they've been relatively slow to change.
Carlos Gill at Micro Equities, clearly the advertising business held by newspapers has been ripe for the plundering by internet-based businesses. What other forms of business have successfully been infiltrated by online businesses?
I think online travel is one area where the internet tools are particularly useful for purchasing and for pricing comparison, and that's an area that we're seeing an increased prominence of the online players rapidly gaining market share on the bricks and mortar traditional players.
Any others? Travel and accommodation. We've got whatif.com has obviously been very successful on the stock market as a hotel accommodation website, travel booking site, Webjet. even outside the Australian stock market, areas like banking, ING being basically an online bank?
Yeah, banking is another area that's grown to develop over the last 10 years. What we're seeing in Australia is that we haven't seen a dominant non-banking financial institution come into the market and grab market share. What we're seeing in Australia is the big four banks all developing online policies and online banking facilities and catering to that side of the market. But interestingly enough, in some places such as Europe and the US, you've seen the emergence of specialist online financial services providers that have challenged some of the traditional banks. But we haven't seen that occurrence in the financial services sector in Australia. We've seen the banks lead the investment and R&D into internet banking. But just in our investment universe, I think the only really true tested business model that we can reliably invest in is within the travel space, and Webjet is the other player in travel.
We'll come back to those stocks in a minute. Tim Morris at Wiseowl. Tim, as we've been saying, Seek and realestate.com.au and carsales.com have been very successful. What do you see as the possibilities to come along as the second tier of internet-based businesses?
Well, you can see that, James, that those that have been successful, they've infiltrated industries with very low barriers to entry. We've seen online operators develop in the financial services market, but as we were just discussing, there's been no big independent player come in and grab market share because the barriers of becoming a new player are significantly higher. So in terms of a second tier of internet-based beneficiaries, I think we're witnessing a real shake-up in the media space at the moment, where the traditional media platforms are becoming entangled with entertainment on the computer and IPTV and so forth. So I don't know where the rubble will end up, but there's some foundations that are being shaken in the media space.
It's a paradox, Tim, that when you say that barriers to entry are low, and they are, that means that first mover advantage is very critical, and clearly Seek and realestate.com.au and carsales.com grab that first mover advantage.
Yeah, it's very important to establish scale, and but you're kind of treading water all the time, because there's always, when there is such low barriers to entry, you're always protecting your market share against other competitors. And I think particularly in the travel space, you're seeing a lot of larger international players try to come in and eat some of these companies' lunches. I mean, with the likes of What If and Webjet, I was walking down Martin Place the other week, and Warwick Kappa has a new travel website that he's fronting these days. So there's a lot of people that can get involved in that space, and it's important to remain proactive in maintaining that first mover advantage.
So does that mean that a jobs website like Seek is vulnerable if another competitor with deep enough pockets tries to have a crack at it? For example, whatever happened to Monster?
Indeed. It's one of the risks, and that's why sometimes hesitant to pay the premium multipliers which these stocks attract in the marketplace. With the realestate.com, I think, is a good example, which has good protective measures in place through its relationship with the agents themselves. But companies like Webjet and What If, I think, may be a little bit more vulnerable to competition.
Rob Hopkins at Smallco, the dynamics of an internet business or an internet industry, it seems that, as you were saying, that the one company tends to dominate, the second company might be able to make some money, and the third company struggles. Does that always remain static, or is there scope for second and third to knock off the incumbent, or are they always doomed to second and third fiddle?
In the clear verticals of cars, houses and jobs, it certainly seems to be basically always the case that number two is doomed to play second fiddle, and realestate.com is a classic case of that, where they a couple of years ago had an operation in the UK. They were number three. They bought the about equal number three and got themselves up to number two-ish, but was still losing an awful lot of money and really not looking like improving. And why the share price over the last couple of years has really done so well is that they've divested themselves of their UK business and just given up on that, and just concentrated on Australia and Italy, where they've got a strong position as well. So I think in those cases it's fairly certain that the number one player will always remain dominant. But I thought Tim made a good point. With the travel companies, it's much less clear. And so What If in particular has a lot of inventory, but it's relatively easy for companies coming into this market to be able to also get hold of that industry by going to the international GDS systems. They will pay a bit more for it, but the user probably isn't aware of that. And so competitors can come into that market quite easily and quite cheaply. If you're trying to compete with realestate.com in the Australian market, it's almost impossible to, no matter how much you spend, get hold of all the inventory, because it's with all the real estate agents who are currently all using realestate.com. Then all the eyeballs stay online, stay with realestate.com, and it's very hard for a second player to come into the market. And so the number two player in the real estate market in Australia is Domain. They're quite strong in Sydney and Melbourne, but and in the more affluent suburbs as well. But outside of that area, they're quite weak, and it's probably going to remain that way going forwards.
Now, we talked about in the article that a potential problem with, for example, What If, is that it relies on distressed inventory, and as things pick up, it's easier for hotels to fill those rooms in more normal fashion.
Well, that's correct, and that does seem to be happening at the moment, and that has meant that What If has come out and indicated that the first half of financial year 11's profit is probably not going to be ahead of, is not going to be ahead of the same period last year. And that's the first time since its listing where its profit has actually gone backwards on the previous corresponding period. And part of that is because of this situation where there isn't as much distressed inventory. Part of it was that 12 months ago, they had an extension of their booking window, which gave them a very strong growth period, and they haven't had that in this period. And the third thing is the strong Australian dollar has meant that a lot of Australians have decided to travel overseas rather than travel within Australia, and What If is not nearly as strong with its overseas offering as it is in its Australian offering.
Carlos Gill at Microequities, what do you think of What If and Webjet in terms of how they rate vis-a-vis the more successful Seek, realestate.com.au and carsales.com?
Well, there's a big difference in terms of the business exposure that What If has compared to Webjet. Webjet is essentially in the airline ticket business, whereas What If is in room inventory. We are seeing a different growth strategy and a different marketing strategy. Webjet has been very active in all sorts of traditional non-internet advertising. They have gone and done free-to-air TV. They're quite aggressive in protecting their market share and creating a brand name out there. We've seen a recent operational update that suggests that total transactional values are still growing far ahead of the airline industry, suggesting that Webjet's still gaining market share on its traditional rivals.